Good evening, everyone. Wall Street ended April with one important record. The Dow, the blue chip index, is now at an all-time high, its first record close for 2014. The milestone came on a day when the Federal Reserve wrapped up its policy meeting, deciding to keep its key interest rate unchanged at 0%, and despite mixed reports about the U.S. economy. First, let's get those closing numbers on Wall Street. The Dow rose 45 points to 16,580. That's the new record, and the Dow is now fractionally higher for the month. The Nasdaq was up 11 points, but down 2% for April, and the S&P added 5 points and is also higher for the month. As for that data, economic growth in the first 3 months of this year was much weaker than expected, up just 0.1%, with the blame going to nasty winter weather. But there was some good news about jobs. Payroll firm ADP reported 220,000 private sector jobs were added in April. That's the most since November. Steve Leisman has more on today's Fed decision and what all those economic reports tell us about the state of the U.S. economy.
Two reports ending in DP today, ADP and GDP, and they couldn't be more different. GDP was a real shocker at a just barely positive 0.1%. That compares to Wall Street's estimate of 1.1%. Consumer spending was up 3%, but a good portion of that was increased spending on health care as a result of the Affordable Care Act. Housing was down nearly 6% for the second lousy quarter in a row. Business equipment continues to disappoint, and government spending was down 0.5 point, failing to bounce back from the depressed numbers resulting from the government shutdown. Economists at BMO said the American economy virtually stalled early this year in the face of severe winter weather. One reason for optimism in the months ahead are numbers like ADP, the payroll company whose data is used to forecast the government jobs report this Friday for just the private sector. Those numbers continue to show good job growth in the economy. They saw private sector growth of 220,000 compared to an estimate of 210,000, and March was revised up by almost 20,000. Non-farm payroll estimate for Wall Street, 215,000 for the government report on Friday. Late in the day, the Fed seemed to take the GDP data in stride, blaming the slowdown, at least in part, on the weather, and following through on Wall Street's expectation to reduce its bond purchases designed to drive down interest rates. The Fed signaled more tapering ahead, while at the same time promising to keep short-term interest rates low for what looks like well into 2015. For Nightly Business Report, I'm Steve Leisman.
Mohamed El-Erian joins us now with his analysis on the Fed and the economy. He's Chief Economic Advisor at Allianz. Mohamed, good to have you back with us. I want to get your reaction to a couple of things. You've got the economy basically flat in the first quarter. You have the Fed pulling back on its stimulus, something that worried a lot of investors, and yet the Dow sets an all-time high. What's not computing, if anything?
So, Tyler, think of it this way. And today was a perfect example. The Fed is on autopilot. We pretty know what they're going to do. They're going to reduce by $10 billion at every meeting their QE3, and they are going to keep interest rates low and continue to encourage us to believe that interest rates are going to stay low for a long time. So the Fed is predictable. Markets like that. The markets also look at the economy and say, yes, we had a weak GDP number, but as Steve said and as Susie said, we had a good ADP number and we had a good business barometer number. So put these two things together, and what the markets see is basically a range-bound outlook, a lower volatility range-bound outlook. And what does that do? It encourages the market to leverage. It encourages the market to reach for yield and to reach for return, and pushes both the bond market and the equity market higher.
But, Mohamed, first of all, nice to see you again. Glad you're back on Nightly Business Report. You've heard this. The new buzzword with policymakers is liftoff. They're talking about the time when they will raise interest rates. When do you think that'll be? And when that does happen, is that going to be good or bad for investors and for the economy?
So nothing today suggests that we really are near liftoff. If you look at the poor GDP number, yes, business investment, weather impacted, was an issue, but also exports were an issue. And the rest of the world is simply not as buoyant. So we're not at liftoff, but neither are we at stall speed, right? So the Fed will stay as it is, and I don't suspect you're going to see interest rates hiked for quite a long time.
Mohamed, is the withdrawal of stimulus in the form of the quantitative easing, is it a non-factor for equities and asset prices?
No, it is a factor, but it's a factor whose impact will be felt later on. You know, at the end of the day, in delivering returns, lots of people are very short term. So when valuations keep on going up, when your return objective stays the same, and when you don't see the turn in valuations till further down the road, you are tempted to stretch a little bit more. You are tempted to do that extra bit of leverage. And that's what we're going to see, and it's going to continue to do so. Hopefully, and this is really important, hopefully a better economy will validate these valuations. Right? The risk is it doesn't. But this is typical technical behavior when you tell people you're in a range-bound world and you give them high return objectives.
Right, right. Let's look a little bit outside the United States. I'd like to get your thoughts on all of these headlines we've been seeing about new sanctions, about Ukraine. How much does this concern you, especially if they get to be really serious sanctions? And also, what's on your worry list?
So if they get really serious, and let's define what we mean by serious. It means going from targeting individuals to targeting sectors. And if these sanctions hit finance and energy, then you can expect two things to happen. You can expect the Russian economy to start suffering really negative growth, which means it will trade less with Europe. And you can expect counter-sanction. You can expect them to take steps to limit the supply of energy to Europe. If that happens, so two big ifs, if that happens, you tip Europe into recession. And then the markets look at something very different. Right now, the markets are discounting this because it's in no one's interest to tip both Russia and Europe into recession. The problem is that every day the news out of Ukraine suggests that everybody's losing control of developments on the ground.
Mohamed, your departure from PIMCO a few months ago was characterized by many as rather abrupt. Was it as abrupt as it seemed? And it certainly seems as though it became, in the aftermath, quite personal. I wonder whether there was a connection between how personal it became and the fact that PIMCO itself, corporately, has had a lot of outflow of capital over the past year. So two things first. Was it as abrupt as it seemed? And basically, why did it seem to get as personal as it did?
So I can't speak to how it was viewed. I can tell you what it's like from my end. I spent 14 wonderful years there. I spent 6 years as CEO and co-CIO with one of the world's best investors. It was time for me to do something different. It was time for me to spend more time with my daughter, and it was time for me to have a portfolio of part-time activities as opposed to one full-time job. So the time was right, and what's wonderful, Tyler, is I leave behind a very strong firm full of talented people and full of great investors. And that's what matters ultimately for the clients.
If you were still CEO, how would you deal with this $50 billion of outflows? Is there anything you could do?
So you continue to do what you've been doing for years, which is deliver long-term value to clients. You continue to deliver thought leadership and the best client servicing. And that's what PIMCO does. So, we have to remember that it took PIMCO 39 years to go from 0 to 1 trillion. It took PIMCO just over 3 years to go from 1 trillion to 2 trillion, right? So you've got to put this in a historical perspective.
Mohamed, good to see you. You look well, you look rested, and we look forward to seeing you again soon.
Thanks for having me on.
Mohamed El-Erian of Allianz.